Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day. This is a quick series. We call it Fin Tips, actually, because we're teaching advisors. So we like to teach you really quick and get out of your way so you can learn something new, hopefully, and enjoy that. Hit the thumbs up button, all that great stuff. More importantly, hope you'll appreciate it. Check us out at jazzwealth.com. If your advisor does not teach you or help in any way, maybe you'll transfer over to Jazz. Very non-intimidating, fun kind of company. Anyways, we're going to talk about RMDs today because we get a lot of questions on RMDs. I don't think we've covered these in a while. I'm going to give you 4 facts, things you may not know, or how to actually figure these things out for your RMD. First of all, just quick definition, RMD stands for Required Minimum Distribution, and basically it's something you have to do on accounts where you didn't pay tax, right? So think of your 401k. You put money in, you got to reduce your taxable income. The government said, nah, we don't have to take any tax money from you now. We'll wait till later. Well, required minimum distribution is the government's way of saying it's later, we'd like to get paid now, right, before you die. So that's what it is. You have to take money out. You're essentially forced to take out a required minimum amount in each and every given year. This applies to tax-deferred accounts, 401ks, 403bs, 457, other accounts like TSP, TSAs, SEPs, simple IRAs. So if I mention any of those in there, at some point, you will be forced to take money out of your account. Tip number 1, let's just get into it. Tip number 1 is in 2020, if this is when you're watching this, it's a special year, right? I think we could all agree 2020 was an interesting, special year, and we still got the election to go. Anyways, in 2020, the government said, whoa, there's a lot going on. Tell you what, this year you don't have to take an RMD. They don't do that often, so don't expect they're going to come around doing that again. Right? What they did is they saw the stock market fall over 30% and they said, look, we got retirees out there that are being required to take money out of their IRA. Let's stop it this year. Let's not force them to do that. That way it has time for the markets to recover. And when they take money out next year, maybe the markets will be higher. So tip number 1 is RMDs actually this year, because of what the stock market did, are not required. Good for you, right? Tip number 2, in most accounts, you're actually required to start required minimum distributions at the age of 72. The way it works is the year, it's the April following the year you turn 72. So just because you turn 72 doesn't mean anything. It is the year following the year in which you turn 72. You turn 72 on July 4th or something. Yay, Independence birthday. The next year, by April, you got to take the RMD. You can take it any time, but the next year, is the cutoff is by April there, you got to do that. What happens if you keep working? What if you're like 73, 74, you love your job, you own a business, you're still in great shape, you want to keep working? Well, then that rule's a little bit different. The RMDs start in the year following the year that you retire. So if you're 73 years old right now and you're still working and it's November, you might as well just wait till January, right? Because then you have all year plus the next year up until April to take your RMD there. So that's an example, right? You don't have to take them if you're still working. This applies to 401ks and things like that. Number 3, you better take your RMD, because if you don't take it, or you forget, or you say, oh my God, nobody told me, I forgot to take it, whatever happened, you actually owe a 50% tax or penalty on the amount you were supposed to take out. That's a lot. I'll give you an example in a second, but that's a lot of money. Don't do that. So if you just remember, just when you get in your 70s, just start thinking, I'm supposed to take something out. Let's start taking some money out. All right, and then number 4, how the heck do you calculate these things, man? The RMDs are largely automatically calculated for you these days, but how do they come up with this stuff? The way it works basically is, well, we do it automatically for our customers, and we'll make sure that happens. But basically, you take your account balance on December 31st of that previous year, and you divide it by what's known as a distribution period. I feel like Austin Powers. Distribution period. You can look it up. There's a table on the IRS's website there. It depends on how old you are. For example, I just did this for a customer. If you're 71 this year, and you are required to start taking the required minimum distribution next year, because you're going to be 72, it'll be April. Let's say your account balance, for easy math, is $500,000 at the end of this year, and you're required to start taking these distributions. What you would do is take $500,000 and divide it by, don't hold me to this, I think it's 27.4. I think. It could be 27.6, somewhere in there. We just did it. We figured it out. It's all good. I think it's 27.4. So basically, you would end up with 500,000 divided by 27.4. You've got there you go. You've got $18,248 is what you would be required to take out. No more if you don't want to, but if you don't need any of the money, you still have to take that money out, so just beware of that. And then the distribution table, distribution period is actually a table you can look up on the IRS website. Depends on how old you are, they're factoring how many years you have to live. Essentially, this all boils down to the IRS just saying, we let you slide all these years not paying taxes. We recognize you're getting older. You ain't going to live forever, so we'd like to get some tax money on that. So hopefully that helps there. Something to consider. Your RMDs. Maybe you learned something. If you did, you hit the thumbs up. Hit the subscribe button. We do like that. And more importantly, hopefully you recognize we are teaching advisors here. It's something we love to do, so people ask questions and they get to learn more. If you are working with somebody, the advisor's not helping you, or you don't like them or whatever, hopefully it'll keep us in mind at Jazz Wealth. We really do appreciate everybody who has joined us. Small company, and it's hard enough to get one customer out there as a financial advisor, so I do appreciate the shot that all of you have given us, and I'll wish you a great rest of your day, and thanks for watching. Enjoy.